Thank you very much. Yes, so what I'd like to speak to you about is the economics of merchant solar co-located with battery storage. And before I jump into this, let me just introduce myself. My name is Mateusz, Wronski, and I'm head of product development at Aurora. Aurora is a analytics, data, and forecasting company set up in Oxford 6 years ago. And we provide forecasts of power, prices, but also in-depth analytics for new business models that emerge as we transition towards clean energy. So in practice, that means that we are heavily focused on modeling business models, including batteries, including DSR, and basically everything that is a little bit more complex than just plugging in the power price curve. We operate from 3 offices across Oxford, Berlin, and Sydney. We've got around 120 people now and around 250 subscribers. There's companies that subscribe to our research. Great. So let me kick off with a short agenda. What I'll talk to you about firstly is the economics of merchant solar and why we're talking about merchant solar today, specifically with the example of Great Britain. Secondly, the business case for co-locating solar with batteries. And thirdly, how that co-location can make potentially your business case more resilient to different market outcomes. Okay, so firstly, the first thing to understand is how the British, in this case, electricity system is going to change over the next 20, 25 years. And what you can see here is the evolution that basically bears out 3 big trends. Firstly, you can see a big growth in renewables. That's unsurprising. We expect, despite there not being any subsidies, almost tripling or 2.5 growth in solar capacity between 2020 and 2040, large growth in onshore and offshore wind. So that's one trend. The second thing you can see here is a decline of baseload technologies. So CCGTs and coal. Coal is obviously being phased out by mandate by 2025, but CCGTs are becoming less useful, and instead they're replaced by flexible technologies, specifically batteries, DSR, reciprocating engines. So everything that allows you to effectively fill in the gaps when the sun is not shining or the wind is not blowing, and that can play potentially the arbitrage game, as is in the case of battery. So that's the overall evolution of the system. Now, whether we will see this growth that I've shown you here in solar or not depends largely on how good the economics of solar systems are. And what you can see here is what we expect the project IRR for effectively a merchant solar plant to look like between now and 2040. And what you can see here is that at the moment we are still rather below what would be the hurdle rate for a merchant project. Now, why is this hurdle rate so high? You might be thinking, well, I've been doing projects for 5%. This is the case because they are merchant. So obviously more risk, you require more return. And what we expect is that effectively hurdle rate is going to be reached around 2024 in the case of Great Britain for solar itself. Now, some more bullish investors potentially can make it stack up earlier at 8% if they can accept a bit of a lower rate of return. Now, why is that important? Like, how do we think about this risk return? One of the key things that are risky about solar investment in this new economy, in the merchant solar investment, is obviously price cannibalization. Solar is highly correlated. That means that when sun shines and when one solar panel is producing, so is everyone else. And obviously that leads to a price cannibalization impact, meaning that the average price when solar does produce is lower than the average price over the horizon. So what we illustrate here is effectively the difference from the baseload price to solar PV capture price. And you can see that as you deploy more solar, the difference to baseload price increases, unsurprisingly. And you can see these bubbles showing you the deployments, and you can see how the line effectively goes down as you deploy more solar. So that's one of the key hurdles for merchant solar. How do you go around this problem of cannibalization? How do you make yourself comfortable with your investment knowing that solar opportunity, in a sense, itself? Well, batteries can be one of the solutions, and I'll show you how. Broadly speaking, when speaking about how batteries can help with this type of risk, you can think about three different ways of mitigating it. Firstly, you can look at standalone battery and solar or winds. Now, what that does, it still allows you to reap certain benefits, because solar and battery tends to be inversely correlated, or rather negatively correlated, when it comes to returns many times. That means that the portfolio benefits of having them together are there. And what we're showing you here is different benefits across different potential, I suppose, usage of battery plus renewables. The other one is retrofits, which is effectively deploying batteries together with solar when you have an existing asset. And the focus of today will be, what if you just build a new system which has batteries and solar? And what you can see also here is the different, I suppose, impacts on these different business models. So portfolio benefits I've already mentioned. Cost savings. Cost savings means you save certain costs, and I'll get into this in a second, by co-locating. Oversizing your assets. You can afford to oversize your solar relative to your grid connection if you have a battery there that you can charge. Suboptimal dispatch is something that's a negative, obviously, because if you have a battery co-located with solar, that means that you have to take into account the fact that sometimes you will want to dispatch battery in the wholesale or balancing market, but you won't be able to because solar is producing at the same time. So you have to take that into account. And finally, the last benefit, or the last impact, which is positive, is self-balancing. If your actual output from a solar plant or from a wind farm deviates from what you had expected, so from your final physical notification in the case of GB, then you can use the battery to balance that and to address the shortfall. As you can see, the new build business model allows you to reap most of these benefits, because you get full portfolio benefits, full cost savings, and asset oversizing benefits, and full self-balancing benefits, but it also suffers from suboptimal dispatch. And let me get into the details. So what we've analyzed as a part of our work on solar plus battery, and before I jump into this, I should mention that we've done this a report together with Wylands Bank and Anesco. Wylands Bank is one of the lenders who are very interested in the financeability of merchant solar, and Anesco is one of the leading developers in the GB space who are actually deploying solar plus battery systems. And what we have analyzed with them is a whole bunch of different configurations of how you can co-deploy solar with battery. And we're showing you here two kind of optimal configurations. Well, one is optimal configuration where you have a constraining grid connection. So effectively the grid connection is smaller than the sum of your solar plus battery. And you can also see the oversizing of solar, of DC AC oversizing of 1 to 0.83. And you can also see below the optimal configuration without oversizing. So effectively have a size of the grid connection matching the sum of the capacities of the battery and solar. And if you analyze these two models, what do you get? Well, I'll walk you through this chart because this is effectively the crux of our finding. What you can see here is effectively the on the left-hand side, the revenue and costs if you were to deploy these two technologies on a standalone basis. And what you can see is that if you discount this at 6%, you get to a negative NPV, which means that the IRR is below 6%. In this case, it's exactly 4%. So you'd get to 4% IRR if you were to just have these two assets together, accounting for all the revenue and all the costs. You can see how much of it comes from solar, how much comes from battery. Now, what happens if you co-locate is, firstly, you realize a big cost saving. And where this cost saving comes from is effectively 3 points. You save on the balance of system, you save on the fixed costs, and you save on the grid on effectively having the grid connection. And you have the grid connection saving because you've oversized this, so you have a smaller grid connection, and you have a suboptimal dispatch impact. So I've already mentioned that there will be some negativity here, and the negative impact is effectively through suboptimal dispatch. And that gets you to the IRR of 7.2%. So you've got a 3.2 percentage point boost in IRR through co-locating battery with storage. Now, what does this look like without or with a non-constraining grid connection, so without oversizing the system relative to the grid connection? You obviously have less cost savings, so you don't have this additional grid connection cost saving from oversizing. You have a smaller system as well, so all the numbers are scaled down, but you can see that you get to an IRR of 6.6%, so still a relatively big boost, but smaller than the case of constraining grid connection, unsurprisingly. Now there are a few variants here you can play with. One of the things you can do is increase the size of your battery. We think that our modeling shows that this can additionally increase IRR by 0.4 or 0.5%, and you can see it's in these two charts for a constraining grid connection and non-constraining grid connection case. And additionally, what you can do, because you have that battery, is you can start playing in different markets. So you don't have to constrain yourself to just the wholesale market, which is what we modeled initially. What you can also do is start playing with the balancing market. And you can see the comparison between Aurora modeled battery plus solar case and the experience of Anesco. Anesco actually managed to achieve higher returns in reality on their solar plus battery system, partly due to participation in the balancing mechanism and the volatility in the balancing mechanism, which allowed them to capture additional value with their battery. Okay, so there are clearly some savings to be had. There's clearly an increase in IRR from co-location. What is also interesting, which I hinted on at the beginning, is the whole risk. So how do you manage risk? Like, what is the impact of having a battery with solar on how risky your investment is? And this is effectively a snapshot of how you can think about this. We, in practice, modeled in a lot of detail, but this is just, I suppose, a summary overview. And what you can see is on the left-hand side, 3 risks for these assets. For solar, one of the largest risks you can have, like I said, is high solar penetration. And obviously that has a big negative impact on the proposition for solar. However, as I've already foreshadowed, for battery that's a good case. The more renewables, the more solar on the system, the more volatility. That means that you can effectively capture higher spreads and potentially charge and discharge more frequently. Well, a risk for battery, on the other hand, is what if the price volatility is lower? What if we have other flexibility in the system, maybe from EVs, maybe from more flexible demands? Well, that's a bad outcome for a battery, obviously. Battery likes volatility. It likes charging and discharging, capturing big spreads. It's a good outcome for solar, however, because typically that additional flexibility will help with that cannibalization impact. So it's because you have this negative correlation, or rather different behavior in some of the risky scenarios, you can capture specifically, you can protect your asset from specific risks. Now that doesn't mean that it protects you from all risks. If you have a low commodity scenario, if your gas prices collapse or if your carbon prices collapse, that doesn't help you too much. And obviously investors have to be aware of that. It's not a perfect hedge with a battery. We've analyzed this across a group of scenarios. We've analyzed this investment case across a bunch of scenarios because what we wanted to do is look at how financeable this proposition is. And obviously, you have to think about the downside case. You have to think about the debt case when you're talking about that. So what we've done here is effectively looked at the downside case and the low gas case, which are some of the most typical investment curves effectively used by project financiers. And you can see that that can have a negative impact on IRR by up to 2.8%. And you can see the assumptions below that. I'm not going to go through them. You can also see the upside and how much upside can be realized in a higher case scenario. Now, why this is important and understanding these risks is important is, like I said, in the context of financing. There's a lot of data on this chart, so probably not going to go through all of this. But the upshot of the analysis we're showing here is that leverage in merchant solar is possible when co-located with battery. And if you take one of these low cases from here and size your debt with a DSCR of say 1.5, which is what banks would be prepared to use in this case, you could achieve a leverage of between 30 and 40% depending on particular case. That means that your equity IRR would increase by some 0.3 percentage points by adding that debt. This can increase to 0.5 percentage points under certain assumptions and perhaps under more assumptions from the banks. Okay, so just to conclude, subsidy-free solar is coming. It's very exposed to power market prices, so it's a risky investment. But co-locating it with battery can firstly unlock additional revenue streams and can protect the business case from the variety of different outcomes. In terms of the IRRs that you can expect in GB specifically, 7 to 8% for a project deployed in 2020. Obviously there is risk. 3 percentage points across key markets risk is the downside that you can expect. But sizing debt against that risk scenario still allows you to achieve a leverage of around 35 to 40%. And finally, the last point, which I haven't made yet, is this is all fine and dandy in theory. In practice, there's some regulatory hurdles that have to be overcome. In Great Britain, Ofgem, the regulator, has been actually pretty swift in addressing some of the key obstacles. One of them has been the double charging of batteries, so battery had to pay final consumption levies when it was charging. It also, for small batteries, was impossible to participate in the balancing mechanism. All these hurdles are being addressed at the moment, and Ofgem is doing a great job addressing this. And we see similar regulatory push in other countries which are looking at merchant solar, including obviously Spain. Great, thank you very much.